Question 7. What is the future of Bitcoin ETFs? The future of Bitcoin ETFs remains uncertain and shrouded in complexity. Several factors contribute to this uncertainty. 1. Regulatory developments. The regulatory landscape surrounding Bitcoin and cryptocurrencies is still evolving, with different regulatory approaches taken by various jurisdictions. This uncertainty can impact the availability and structure of Bitcoin ETFs in different regions. The approval process for spot Bitcoin ETFs in the United States remains ongoing, and their future availability is contingent upon regulatory decisions by the Securities and Exchange Commission (SEC). Continued progress and potential approvals could significantly shape the future of this segment of the ETF space. 2. Institutional adoption. Increased institutional adoption of Bitcoin could drive demand for Bitcoin ETFs. As established financial institutions see value in this asset class, the demand for regulated investment vehicles like ETFs could surge. This increased demand could contribute to the growth and acceptance of Bitcoin ETFs in the future. 3. Technological advancements. Advancements in blockchain technology and the surrounding infrastructure could enhance the security, scalability, and efficiency of Bitcoin. These improvements could address some of the concerns raised by regulators and potentially pave the way for wider acceptance of Bitcoin ETFs. 4. Market volatility. Continuing volatility in the broader cryptocurrency market can influence the adoption of Bitcoin ETFs. Periods of significant price swings might deter investors from entering the market, while periods of sustained growth could attract more interest in this asset class and potentially boost the demand for Bitcoin ETFs. 5. Alternative investments. The emergence of alternative investment options in the cryptocurrency space, such as cryptocurrency index funds or decentralized finance (DeFi) ETFs, could compete with or complement Bitcoin ETFs, shaping the competitive landscape of this niche market. Overall, the future of Bitcoin ETFs likely hinges on a combination of these factors, making it challenging to predict their trajectory with certainty. However, continued dialogue between regulators, industry stakeholders, and investors will play a crucial role in determining the future landscape of Bitcoin ETFs and their potential impact on the broader financial ecosystem. Question 8. What are the differences between Bitcoin ETFs and Grayscale Bitcoin Trust (GBTC)? Both Bitcoin ETFs and Grayscale Bitcoin Trust (GBTC) offer indirect exposure to Bitcoin, but they differ significantly in several key aspects. Structure. Bitcoin ETFs. These are exchange-traded funds, similar to stock or mutual funds, that trade on regulated stock exchanges. They operate as baskets of assets that aim to track the price of Bitcoin. This can involve holding physical Bitcoin, Bitcoin futures contracts, or other derivatives. GBTC. This is a trust, not an ETF. Trusts operate differently and are not subject to the same regulations as ETFs. GBTC holds physical Bitcoin directly, not a basket of assets. Regulation. Bitcoin ETFs. These undergo a rigorous approval process by regulatory bodies like the SEC in the US. This process ensures compliance with regulations and aims to provide investor protection. Currently, no spot Bitcoin ETFs are approved in the US as of February 2024, while Bitcoin futures ETFs are available. GBTC, as a trust, GBTC is not subject to the same level of regulatory oversight as ETFs. This can be seen as both an advantage, less regulatory burden, and a disadvantage, potentially less oversight. Investment strategy. Bitcoin ETFs. These offer varying strategies based on the underlying holdings. Spot Bitcoin ETFs aim to directly track the price of Bitcoin by holding the cryptocurrency itself, unavailable in the US as of February 2024. Bitcoin futures ETFs invest in Bitcoin futures contracts, offering indirect exposure, but potentially exhibiting different price movements compared to spot Bitcoin. GBTC holds physical Bitcoin directly, aiming to track the price of Bitcoin through direct ownership of the cryptocurrency. However, GBTC shares trade on secondary markets, not directly like ETFs, and are not redeemable for Bitcoin. Fees and expenses. Bitcoin ETFs typically charge management fees and other operational expenses. These can vary depending on the specific ETF and its underlying assets. GBTC charges a management fee and a creation and redemption fee. These fees can be higher compared to management fees of some Bitcoin ETFs. Liquidity. Bitcoin ETFs generally offer high liquidity, allowing investors to easily buy and sell shares on stock exchanges. GBTC may have lower liquidity compared to Bitcoin ETFs due to its structure and trading on secondary markets. Transparency. Bitcoin ETFs subject to strict reporting requirements, providing investors with greater transparency regarding their holdings and activities. GBTC may have less transparency compared to Bitcoin ETFs, as disclosures might not be as detailed. Question 9. How do Bitcoin ETFs compare to other ways of investing in Bitcoin? Several alternative methods exist for investing in Bitcoin, each offering distinct advantages and disadvantages compared to Bitcoin ETFs. 1. Directly buying Bitcoin. Benefits. Direct ownership. You have full control over your Bitcoin, allowing for potential future spending or transfer opportunities. Potentially lower fees. Avoiding management fees associated with ETFs can be appealing for some investors. Privacy. Depending on the platform, you may have greater control over the privacy associated with your Bitcoin ownership. Drawbacks. Security risks. Managing your own wallet and securing your Bitcoin exposes you to potential theft or loss. Complexity. Understanding and navigating cryptocurrency exchanges and wallets requires technical expertise. Regulation. Unregulated exchanges can be risky, and regulations might change rapidly, impacting accessibility. 2. Bitcoin mining. Benefits. Potential rewards. You can potentially earn Bitcoin as a reward for verifying transactions on the blockchain network. Decentralization. By participating in mining, you contribute to the decentralized nature of the Bitcoin network. Drawbacks: high technical barriers. Setting up and maintaining mining equipment requires specialized knowledge and can be technically demanding. Significant energy consumption. Bitcoin mining utilizes significant amounts of energy, raising environmental concerns. Volatile rewards. Mining rewards are not guaranteed and can fluctuate based on network complexity and competition. 3. Peer-to-peer, P2P, marketplaces. Benefits. Direct transactions. You can directly buy and sell Bitcoin with other individuals, potentially offering greater privacy. Potentially lower fees. Avoiding exchange fees can be appealing, depending on the specific platform and transaction size. Drawbacks. Counterparty risk. Transactions involve trust in the other party, increasing the potential for scams or fraud. Limited liquidity. Finding buyers or sellers might be challenging, especially for larger transactions. Security risks. P2P platforms might not offer the same level of security as regulated exchanges. Comparison with Bitcoin ETFs. Bitcoin ETFs offer a more accessible, regulated, and potentially less risky way to gain exposure to Bitcoin compared to directly buying Bitcoin on an exchange or through P2P marketplaces. They also circumvent the technical complexities and energy consumption associated with Bitcoin mining. However, they involve management fees and do not offer the same level of direct ownership or control over the underlying asset compared to other methods. Question 10. How would the approval of a Bitcoin ETF impact the cryptocurrency market? The approval of a spot Bitcoin ETF in the United States, which is still under consideration as of February 2024, could have several potential impacts on the cryptocurrency market. Potential positive impacts. Increased investor adoption. A spot Bitcoin ETF, offering a regulated and potentially more accessible way to gain exposure to Bitcoin, could attract new investors, particularly those hesitant about the complexities of directly owning and managing the cryptocurrency. This influx of new investors could bolster demand for Bitcoin, potentially leading to price appreciation. Enhanced market legitimacy. The approval of a spot Bitcoin ETF by the SEC could be seen as a stamp of approval for the cryptocurrency, potentially legitimizing it in the eyes of institutional investors and the broader financial ecosystem. This increased legitimacy could lead to greater institutional adoption, further driving demand and potentially pushing prices upward. Improved market liquidity. An ETF allows for easier entry and exit for investors, potentially increasing the liquidity of the Bitcoin market. This improved liquidity could reduce volatility, making the market more attractive to institutional investors and potentially leading to smoother price movements. Increased scrutiny and regulation. The regulatory framework surrounding Bitcoin ETFs could lead to greater scrutiny and oversight of the cryptocurrency market, potentially enhancing transparency and investor protection. This could build trust in the market and attract more risk-averse investors. Potential negative impacts. Short-term price volatility. The approval of a Bitcoin ETF could trigger a short-term surge in volatility due to increased market activity and speculation. This volatility might not be suitable for all investors and could deter some from entering the market. Bubble formation. Increased investor interest and potential price appreciation could lead to a bubble forming in the Bitcoin market. If the price eventually corrects, it could lead to significant losses for investors who entered at inflated prices. Regulatory hurdles. The regulatory framework governing Bitcoin ETFs might evolve and present unforeseen challenges, potentially impacting the availability or structure of these investment vehicles. This uncertainty could deter potential investors and hinder broader market adoption. It's important to note that the actual impact of a Bitcoin ETF is uncertain and will depend on various factors, including the specific features of the ETF, whether it holds physical Bitcoin, futures contracts, or other derivatives can significantly impact its influence on the market. Market conditions. The overall sentiment and existing trends in the cryptocurrency market can influence how investors react to the launch of a Bitcoin ETF. Regulatory environment. The regulatory landscape surrounding Bitcoin and cryptocurrencies as a whole can play a significant role in shaping the market's response to the ETF. Overall, the approval of a spot Bitcoin ETF in the US could have a multifaceted impact on the cryptocurrency market. While it could lead to increased investor adoption, improved market legitimacy, and potentially higher prices, it's crucial to remember the potential for short-term volatility, bubble formation, and unforeseen regulatory challenges. Investors should carefully consider these potential impacts and conduct thorough research before making any investment decisions related to Bitcoin ETFs or the broader cryptocurrency market. Question 11. What should investors consider before investing in a Bitcoin ETF? Here are some crucial aspects for investors to consider before investing in a Bitcoin ETF. Understanding the underlying asset. Spot versus futures exposure. Differentiate between spot Bitcoin ETFs, not yet available in the US, and Bitcoin futures ETFs. Spot ETFs aim to directly track the price of Bitcoin through physical holdings, while futures ETFs offer exposure through contracts that obligate delivery at a future date, leading to potential price discrepancies. Volatility. Be prepared for significant price fluctuations, a characteristic trait of Bitcoin. This volatility can lead to substantial losses and requires a high tolerance for risk. Investment goals and risk tolerance. Alignment with goals. Ensure Bitcoin ETFs align with your overall investment objectives. Are you aiming for aggressive growth despite high risk, or seeking diversification to mitigate volatility in traditional assets? Risk tolerance assessment. Honestly evaluate your comfort level with high-risk investments. Bitcoin ETFs are not suitable for everyone, especially those with low risk tolerance who cannot withstand potential losses. Fees and expenses. Comparison. Compare expense ratios, trading commissions, and other associated fees across different Bitcoin ETFs. Even seemingly small differences can impact long-term returns. Actively managed versus index options. Consider low-cost index ETFs if seeking passive tracking of Bitcoin performance, as they tend to have lower fees compared to actively managed options seeking to outperform the market. Research and due diligence. Trading history. If available, analyze the volatility and tracking performance of the ETF. How closely does it mirror the underlying asset, and how significant are the fluctuations compared to the spot price or target futures contracts? ETF provider. investigate the reputation and track record of the ETF provider. Look for established companies with a commitment to transparency, security, and responsible investment practices. Regulatory landscape. Stay informed about the evolving regulatory environment surrounding Bitcoin ETFs in your jurisdiction. Understand how regulations might impact taxation, investor protection, and future availability of these investment vehicles. Potential challenges. Be aware of potential obstacles like delayed ETF approvals or stricter regulations that could impact the market and your investments. Tax implications. Seek professional guidance from a tax advisor to understand the tax implications of investing in Bitcoin ETFs in your specific situation. Proactive planning helps ensure you're aware of your tax obligations and avoid unexpected liabilities. Alright everyone, that wraps up our comprehensive guide to Bitcoin ETFs. We covered the basics, different types, potential risks and rewards, and even how to evaluate these investment vehicles before making any decisions. Remember, Bitcoin ETFs are not a one-size-fits-all solution. They involve significant risks and require a high tolerance for volatility. Always conduct thorough research, understand your risk tolerance, and consult a financial advisor before investing in any Bitcoin ETFs, or any investment for that matter. If you enjoyed this video, be sure to leave a like and subscribe for more in-depth discussions about all things ETFs. We'll see you in the next one.